Hello, everyone. Matt Druin with Oak Grove Development. We're here today to talk about partnerships, to partner or not to partner. This is a subject that comes up often, and somebody that has a career in real estate is going to be faced with the opportunity to partner with somebody at some point in time. Okay, so we're going to cover one aspect of partnerships. So let's get into why investors and developers partner on real estate deals in the first place, right? So there are three components required for a successful real estate project or real estate development. The first one being opportunity. You have to have an opportunity, a building for sale, a possible land development deal, whatever that case may be. You need to have an opportunity. If there's no opportunity, then there's no deal that happens, okay? Anybody can get an opportunity. So this is a great resource or idea to internalize for people that don't have experience and don't have capital, okay, which I'll go into next. If you have an opportunity but you don't have the experience, then you may be able to fumble through that project, but you're going to make very expensive mistakes along the way, and also your opportunity may turn into a nightmare if you don't have somebody riding along with you that has the experience. Okay, one way that real estate investors with experience or developers with experience partner with each other is they may have two different strengths uh, with as it relates to the real estate field. So one investor may have a construction experience. That may be your general contractor. We partnered with general contractors before on some of our larger deals. Um, that general contracting is not it's not a skill set of mine. It's actually a great weakness of mine. So we're very open to partnering with general contractors where we have the capital raising experience and the finance experience and management experience to go with that. Third thing is you need to have capital. This can be capital from a passive investor or an active investor. Either way, the fundamental component that binds this partnership together is called the operating agreement. Okay, so this is something that you negotiate with your partner, and you have a real estate attorney or a business attorney put it together. Okay, so in my experience with working with investors, partnerships always start off like this. Everybody's feeling good. We are sharing common values. We have a common vision, all of that stuff. And it really, really starts off on a high emotional level. What a lot of investors fail to do is what is the exit strategy for this partnership? They talk about going into the partnership, but not how they exit the partnership. Because things may change 6 months, 1 year, 5 year, 10 year, 20 years down the line. So we want to have the exit strategy identified on the front end and very, very clear, because what happens when partnerships sour or just partners just get tired and want to exit? So sometimes after some time has passed, this is what can happen is that partners can get in disputes about the types of projects they want to pursue together, disputes about management of those assets, all that stuff. So this is how sometimes it can happen is it can turn very, very bitter. Do you want to be negotiating an exit strategy with your partner after things have become very bitter and acrimonious, that sort of thing? Usually these types of situations, if they're not spelled out in the operating agreement as to what the exit strategy is, can turn into expensive litigation, which nobody wins but the attorneys in those scenarios, right? So some of these other things here. Sometimes a partner can just become tired. One has all the energy pushing things forward. The other one is just tired. Other things have come on in their life that they've that they're focusing on. They may be focusing on their partnerships. They may be looking to wind down their career, or quite simply, and most oftentimes, they want to get the equity out of this partnership to put into something else, whether that's another real estate deal or something that's more congruent with their wealth planning strategy at that point in time in their life. So what we're going to do is we are going to make some assumptions and put together a scenario for a partnership exit, right? A wind down of a partnership. So in these assumptions, we're going to assume that myself and my partner, or you and your partner, uh, you know, acquired $5 million in assets over 10 years. Usually real estate is something that is leveraged. That's what we do. That's the benefit of real estate, is that banks consider it a tangible asset, so they're willing to lend to you in order to purchase and develop real estate opportunities. So we're going to assume that we have $4 million in mortgage debt. That is approximately 80% of the total value of the portfolio. Obviously, these things can change, but it's usually not going to be more than 80%. It's going to be less than 80%. And also, what we're going to do as an assumption is that we're going to have a 8.5% capitalization rate on that $5 million in assets that we own together. So that's just an assumption. So that's going to be 8.5% of $5 million is $425,000 annual net operating income. We're going to assume that $4 million in mortgage debt is a 20-year mortgage at 5.5% interest. So it's amortized over 20 years. That will become very important later on. So we have a $95,000 per year in free cash flow. Divide that by half is what each partner is entitled to. This is assuming that it is a 50-50 partnership. So therefore, $5 million minus $4 million is $1 million in equity. Therefore, each partner has $500,000 in equity. Okay. So assume one partner wants to exit. Okay. So at any given point in time along this partnership, one or the other partner may not have $500,000 to buy the other one out in cash, right? Now, backing up a little bit, this $5 million valuation on the assets, that can be structured in the actual operating agreement and customized to be, subject to a third-party appraisal, or even subject to 2 third-party appraisals in case there may be a conflict of it. And sometimes the partners will say, all right, well, we'll just take the average of those 2 third-party appraisals, so we have a high degree of objectivity in valuing the assets. And real estate is a very, very easy thing to appraise. Much harder to do different types of businesses that have proprietary technology or intellectual property and stuff like that. So the first one we're going to do is, a lot of times people will exit by the partner that's getting bought out is going to convert their equity into a loan. Okay, so that loan to be paid all out over a specified period of time. This is completely customizable depending upon what you and your partner negotiate in the front end. The one thing is that you don't want to have something that's so aggressive in terms of a buyout that is going to destroy the business. Okay, so right here we're going to go into the scenario of a 5-year buyout with no balloon. So essentially, the one partner that's buying it has 5 years to pay the other partner back. We're going to assume 8% interest, and the reason why interest is important is because me as a partner, if I am getting bought out and I have to finance my equity position, I have an opportunity cost associated with financing that. I could use that capital for another real estate deal, other investments. So there should be some consideration for the financing that equity position. Okay. We're also going to assume that we're going to have a 5-year amortization on that loan. So after 5 years, the other investor is completely paid back. Okay. So that equates into about $121,000 annual debt service for that buyout. Remember that $95,000 in cash flow that's now completely owned by the partner that's buying you out is basically going to be a negative cash flow position. Some investors may be fine with that negative cash flow position because at the end of 5 years they're bought out. They may have cash flow from other assets that they can do that. So they're just out at the end of 5 years, and they have 100% equity in the deal. So this may be, great, right? So we have, tons of cash flow from other businesses, other assets, that sort of thing. But the one thing you want to be wary of is that there's a lot of things that can change over the course of 5 to 10 years. Who knows that, you think you may have all this cash flow coming in from other assets or your job or whatever, but you may not. There's a lot of things that can change over 1 year, 5 years, 10 years, 20 years. So you want to make sure that you do, you account for that, right? So the other scenario here, which is a little bit safer of an option, is a 5-year buyout with a balloon. It allows you to have better cash flow based upon your buyout. So we're going to do is we're going to have 8% interest, same as the other one, a 10-year amortization, and a 5-year balloon. What this means is that $500,000 is amortized over 10 years, and then whatever is not any unpaid principal is due and payable, all of it after 5 years. Okay, so this leaves about $72,000 in annual debt service for the buyout. Okay, so that means uh, that's the debt service that is being paid to the partners being bought out. The business cash flow is $22,208 a year, so at least you have a little bit of a cushion on there. Now, mind you, why would a partner that is buying out want to have lower cash flow? The reason being is because remember, their cash flow is going from about $40,000 a year down to $22,000 a year. Why would they want to take half of it? The reason is that you have the benefit of waiting until for 5 years to have 100% equity in that, therefore $95,000. We're being very conservative here. That $95,000 could appreciate because usually rents go up over time. Expenses do too, but expenses go up slower than your top line revenue. Okay, so and then we have this balloon payment on year 5 of about $300,000. Okay, we run into the same dilemma again. I didn't have $500,000. What makes you think I'm going to have $300,000? Okay, so we're going to go over that and what we typically do, and a lot of other investors do on overcoming that hurdle. Okay, so how does this balloon get repaid? The balloon can get repaid through refinancing. Okay, so we're going to assume that the bank debt on the properties, the original bank debt of $4 million, is amortized over 20 years. Usually most commercial banks will amortize over 25 years. The $4 million in debt will get paid down to approximately $3.4 million in 5 years. Okay, so that's a considerable amount of pay down, about $600,000. Okay, so assuming the assets stay the same in value, the $5 million in assets, that would give about $1.6 million in equity. Now we're being very conservative here. Over 5 years, if you own assets in great locations and they're managed well, that property will probably tend to appreciate. But we're going to be very conservative here and just assume it's just going to keep its value. Okay? We don't want to create scenarios that are completely unrealistic when we're doing operating agreements with our potential partners. So what a lot of people do is that at the end of the 5 years or before that 5 years, when they have enough equity, is that they'll do a cash out refinance, right? So right here we're going to have do a cash out refinance in year 5, and you place a new loan on the property for $4 million and have a cash out proceeds of $600,000 of which to pay that balloon of $300,000. At that point in time, your partner would be totally bought out, and you own 100% of the asset or equity in that deal. So additionally, you have a few $100,000 within which to basically cash out of, basically take some money off the table and get a debt level distribution to yourself as well, which is tax free, which is also nice too, that you can use for another real estate project or investment. So I hope this has helped you. If you learned or were entertained by this, please give us a comment and review, and let us know what other types of aspects of real estate investing or money for that matter that you want to learn about as well. Thanks again for tuning in. Have a wonderful day.